those are some of the other things you want. Somebody that's thinking dynamically and not just, here's a return, here's the answer this year, we'll see in 12 months.
Hey, you're tuned into the Investment Property Geeks of Charlotte. I'm your host, Chris.
And co-host, Jesse.
All right, and today we're talking about something really fun, tax loopholes, and how to take the most advantage, legally, I should say, from your investment property, or if you're thinking about renting out your property. The tax law is one thing that we find a lot of owners don't really know much about around their property, and it's one of the ways that you really can add some additional return that may not be super evident on the surface if it's not something you're super familiar with. So this is a cool episode to tune into and really try to understand, because there's going to be a lot here that really will help you juice your return on investment.
Absolutely.
But before we get in, well, thank you. Sorry, I didn't mean to cut you off,
No,
Jesse.
you're fine.
Before we get into it too much, check us out on Facebook. Just search Investment Property Geeks or go to investmentpropertygeeks.com, or you can email us at
Investment Property Geeks.
Or podcast at Investment Property
Yeah, that's right.
Geeks. Podcast at investmentpropertygeeks.com. Thanks, Jesse.
We tried. Podcast at investmentpropertygeeks.com.
We're getting close to the holiday break. You can feel it. Okay, so yeah, check us out, investmentpropertygeeks.com. This episode and lots of others. We just wrapped up our 12 episode segment on what is property management. So now that was a lot of good and a lot of fun. We talked about accounting last time, and this is going to be more about how rather than just the straight numbers and how you account for them on your property, this is really more about the tax law and how it's set up to benefit you as an investor. So super excited about that. We have a couple friends with us today. Go for it, Jesse. Introduce our friends.
Absolutely, and we want to thank them for joining us. We have two gentlemen. Peter A. Greevy, CPA, is a 2004 graduate of the University of North Carolina at Charlotte with a Bachelor of Science in Accounting and a Bachelor of Arts in Mathematics. Peter also received his Master in Accountancy from the University of North Carolina at Charlotte in 2007. Peter started his career at Pesta, Finney & Associates, LLP in 2005. Peter works extensively with clients in the real estate industry as well as those in service industries. He's a member of the American Institute of Certified Public Accountants as well as the NAIOP, Commercial Real Estate Development Association. Peter is married to his wife, Dominique, and they have 3 sons. Lance Pritchett, CPA, is a 2003 graduate of the University of North Carolina at Chapel Hill with a Bachelor of Science in Business Administration from the Keenan Flagler School of Business, where he also received a Master of Accounting in 2004. Lance started his career at Pesta, Finney & Associates, LLP, in 2004. Since then, he has worked extensively with clients in all facets of the real estate industry, as well as small business owners and high net worth individuals. He is a past member of the Board of Directors at the Charlotte-Mecklenburg Housing Partnership and is a member of the North Carolina Association of Certified Public Accountants. He is in a fierce struggle with his wife, Jessie, to see who has more clothes.
Who's winning?
Yeah,
Lance?
I was going to say, who's winning that?
I think I am, but she's always coming in hot on my heels. So Christmas is coming, so we'll see.
Yeah, see if it moves the needle at all.
Yeah,
well, hey guys, we appreciate you joining us today, and I'll just chime in and say, my wife and I have been clients of Pesta Finney since we moved here to Charlotte. Love these guys. Always super personable, know what they're doing. They're large enough where they've got a well-diversified team to help with whatever question you might have, but they're not so big that you feel like a number. So anyway, all right, gentlemen, well, welcome. And today we're talking about hopefully something you feel like. I feel super nerdy and excited. I hope you're feeling super nerdy and excited about it. But anything that Jesse left out that you wanted to say about what makes you cool and special?
No, I think he nailed it.
Yeah, he covered all of it, 100%. So yeah, I think we're an open book, and that's the entire book.
Yeah. Okay. Awesome. That's the depth of your personality right there.
Yeah,
those 2 paragraphs. That's great. Hey, well, I was hoping, there's a lot we want to cover today, and we're going to try to kind of give a condensed soup version. So certainly, if folks do have questions, feel free. We did tell you to reach out, podcast at Investment Property Geeks, and we'll make sure to loop these gentlemen in. And then we'll give you their contact info too at the end. So you've got that if you want to engage them or you have any questions for them. I'm sure they'd be more than happy to hop on the phone and chat with you. So, so guys, we get a lot of folks. Everyone has a different experience with the tax law and what to expect and kind of budget and that kind of thing. So maybe I was hoping right off the gate, you could just kind of tell us like, hey, when, as a real estate investor, if you're thinking about renting out your property, when should you think about like, hey, I could just put this in TurboTax or some other software at the end of the year, and that should spit out the number of what I need from me, and that should do the trick, versus, going down the road and hiring, John Doe CPA versus someone who has like specific real estate knowledge. Maybe you could help the audience with that a little bit.
Sure. Yeah. Go ahead, start
So
off.
yeah, I mean, it becomes like, I mean, you got money at stake, right? So if you think you know what you're doing in TurboTax and you're comfortable with that, then okay. But I mean, our job as tax preparers is to save you money. So, I mean, we're not doing our job unless we basically pay for our fee by saving you that much tax money. So, with the Tax Cuts and Jobs Act that was passed a couple of years ago, they simplified the tax code, but they did not simplify it for people that own real estate. I mean, there's extra deductions in there now with the qualified business income deduction, and that's the stuff you don't want to. I mean, that's a 20% deduction on your rental real estate income. So if you qualify for it, you don't want to miss that deduction because that's real tax savings. That's real dollars in your pocket.
Yeah, I think, whether it's any of those three, I mean, the first step is to, have all your facts and your records in order. So I'm sure you guys talk about that and provide that service. But, no matter what you're doing, make sure you've got everything in front of you. You know what you're doing. What are the facts about my property? How did I spend these dollars? What did I use? And some of the stuff we'll talk about really falls into that fact category. And kind of like Pete said, what we got to almost 3 years ago now with the Tax Cuts and Jobs Act was not simplification. And so I think what we've seen in the marketplace is particularly smaller shop CPAs that maybe have older folks that were running them, they're going, we're out. This is a lot. It's a lot to learn because there's all kinds of different breakpoints and thresholds and everything else associated with it. The rules are more complicated, particularly for somebody that is an investor in anything, right? I mean, working stiffs like me and Pete, any idiot can do our tax return.
You guys use TurboTax for your own, is that right?
Yeah. So as you get into more, more non-traditional investments, right? If you're not getting a W-2, 1099, 1098, whatever it is from the government, that's the extent of your tax documents. You need to have a little bit of knowledge if you want to go the TurboTax route, like Pete said, or find somebody that is. And I think just the cost of the technology to implement these tax laws means that to get good advice or even probably good TurboTax is no longer a cheap proposition. So you're going to have to be willing to spend a little bit of money potentially, because even the Tax Cuts and Jobs Act, not permanent, it's phasing out in 5 and 6 years. New administration, probably looking to change a lot of that in a couple of years potentially. So, there's no hard and fast rule to say, all right, well, this is when you move from TurboTax to a CPA or an enrolled agent or whatever to somebody that's sophisticated. But, the more complexity and the more investments and the more you're doing, the further along that continuum you're probably going to need to be.
Well said. Well, I'll tell folks this. We've never, my wife and I, we've never used TurboTax for properties for that exact reason. We're just always afraid we're going to miss out on something. And even my wife, who's a CPA who used to specialize in real estate, like you said, Lance, things are changing so quickly that we still hire you guys to do our taxes. and she's still licensed and current in North Carolina. And she's just like, hey man, stuff is changing so quick. There's just no way we would miss out on a lot of opportunity. And that's true. Every time you guys have helped us every year, like you end up saving us more than you cost us. And you just have good advice and knowledge anyway. But it's funny because like the one thing we did do before, which I wish we wouldn't have when we were living back over in the Seattle area, is we knew someone who could like input it into their software. Still, while my wife was a CPA, I guess we couldn't do it at her firm or something for one reason or another. But she had input into the software for like $500, right? But then, like even me with my very limited knowledge of the tax code, I'd be like, she missed that, and that's wrong, and she didn't amortize that correctly, and so then we had to go back through everything and straighten it all out. And then I talked to you guys a little bit more about some of the things the cool things that you do around, like kind of I always refer to it as like a poor man's cost segregation and things like that that we might get into if we have time today. And it's like, oh man, I missed out on that by by hiring the cheap person to go do it. I didn't get any of that extra benefit that was potentially there. So word to the wise, if you want to get serious about this and you really want to milk it for all she's got, hire someone who knows what they're doing. That's for sure.
Yeah, you get what you pay for usually.
Yeah, exactly.
Yeah, and one of the things I think that we try to touch base with people on at least once a year, I try to, is, particularly when you own real estate, which is a durable asset, right, and not particularly liquid, all right, fine, you got to do some tax planning for this year, and really now you need to look down the road, right, with the Tax Cuts and Jobs Act expiring and maybe rates going up and everything else. But there's a lot of non-tax considerations that I think a good CPA can help you with, or at least be a catalyst for you to do, right? I mean, does now that you have an investment property necessitate you updating wills? Does it change your insurance? Even just the legal aspects of how do you own it, right? LLC, partnership, single member LLC, whatever. And is that something that, you take from you owning as the investor to transferring it to a second generation as far as that goes? So there's not only income tax things you need to be thinking about, but estate, succession, legal, and all kinds of planning. So if you are looking for advisors out there, those are the kind of things you want, even above and beyond the, we're going to do your tax return this year and give you some deduction ideas, because, if you don't transfer that property correctly, or, have it insured properly or whatever, and somebody's not pushing you on that, those losses could be a lot more than not getting the right tax deduction in a given year, or a real hassle for somebody down the road, right? If you don't have it,
sure,
and everything else. So those are some of the other things you want. Somebody that's thinking dynamically and not just, here's a return, here's the answer this year, we'll see in 12 months. What do with this long term? What's the plan? How are you going to execute not only this year but over a period of years?
Awesome. Well, I thought maybe a good place for us to start a little bit before we get into some of the other conversation about what kind of benefits are available to us as real estate investors is really trying to understand the difference. I think we all kind of get what income is, but not everyone understands. And you're going to, like, the way I'm going to ask this question, you're probably going to roll your eyes at me, but like, I know depreciation is an expense, but like, it's a different way. It's not just like a regular kind of cash expense, right? Like we have cash expenses as investors, such as maybe insurance or paying a property management company or repairs at the property or whatever. But there's also this concept of depreciation. And so for a lot of folks, if they're new to renting or they don't have a background in business, there might be like, depreciation, what does that mean? I thought the house appreciates over time. So can you kind of help us out with, like, what is depreciation and how does it work, and generically maybe how do you calculate it, that kind of thing?
Well, so depreciation, basically, you're right. You're writing it off over time, even though ideally the house is appreciating. But if you think about it like a car depreciates in value. If you bought a car for your business, you're writing that off over 5 years. We talk about bonus depreciation too, but similar to a house, even though you appreciate the value, you're getting a deduction every year. You're writing that off over, for residential, 27 years. And then any land improvements you do to the property, like putting in fence or anything like that, that's 15 years. So it's just an expense that you get on your return every year. You're probably not going to hold the property for the 27 years, and it reduces say you spent $80,000 on the house, X amount on land. As you depreciate it, the basis of that house goes down. So whatever 1/27th of 80,000 is every year, that basis in the house is going down. And when you sell it, you're going to recapture that depreciation as income. So it is somewhat of a timing difference, but it's giving you deductions up front versus not having them.
Yeah.
I mean, you're looking at, when you talk about depreciation, it's available for what are called capital assets, right? Things that have an expected life beyond a year. So like Pete said, certainly the house that you're renting, you would hope lasts more than a year. But you've got your, stoves, refrigerators, washing machines, if you got those in there, fences, like Pete said, any equipment that you've got dedicated to the property, right? So if I've got a lawnmower I bought that's on site that's used specifically for my rental property, stuff like that. And all those different classes of assets have different defined lives, right? So if, generally speaking, that those equipment assets are 5-year lives. That's just statutory under the tax code, as Pete said. The house is going to be 27 and a half years. The fence is going to be 15, and that's just because it falls in a certain category. So, you need to be telling, if you do have a tax advisor, all right, I spent money on this year, so they can get it in the proper category and depreciate it. Or there's some very complex rules around, even if you have those types of assets, how much work you do to it, right? If you got an air conditioning and you completely replace it, you're probably going to have to capitalize and depreciate it. If you fix it, you may be able to write it off depending on how far that line is, right? And so the good news is, on a single family house, that's a little bit of a binary thing. What we see in our commercial properties is you may have 10 HVAC units and somebody replaces one. The laws would tell us you could treat that as a repair. But, those rules get complicated, as we kind of let off with. So, that depreciation approximates the wear and tear on those long-lived assets. And under a certain year threshold, you can essentially expense those assets via bonus depreciation. But again, talking about complex rules, that starts to phase down. Right now, it's 100% that you can write off the cost in the initial year, even though you would otherwise write it off over 5 or 15 in the case of land improvements. But the Tax Cuts and Jobs Act stair steps that down starting, I think, in 2022.
Yeah.
You go from 100 to 80 to 60 to 40 and all the way down to 0 unless the law changes. So again, complex rules around that bonus depreciation on top of, which can accelerate some of the deductions that you would otherwise get over a period of time.
Awesome. So I want to, just for our listeners, because I think for folks who are familiar with that, they're like, oh yeah, cool. And then other people are probably like, okay, I think I get it, but what? So let's maybe give an example, and I'll just use a conversation. Pete, you and I had a conversation a couple weeks ago about a property I just purchased, right?
Right.
And we put in, I'm going to call it like 30 grand worth of improvements, plus or minus. Mm-hmm. And of those improvements, I think we talked about maybe most, say, 25 grand of that. I'm not going to hold you to this on my tax return, by the way, but this is for demonstrative purposes.
Right.
But like 25 grand of that is stuff that falls into that category of bonus depreciation. So I just want to tell people
like fridge and stuff. And
yeah, exactly. Right. Yeah.
So
I think we
basically,
determined all but the roof replacement or something might fall into that category. So.
Right. And so, and the roof gets tricky too. Like if you replace part of the roof or repair part of the roof, you might be able to expense it. But if you're replacing the whole thing, that's capitalized. And even the regulations say if you're just replacing the rubber membrane that protects it, that you can expense, but not if you're doing the whole roof. But then for the other 25,000 you're talking about with like the furniture, fixtures, fridge, equipment like that, that's all what Lance was talking about, that 5 and 7 year property, which under the code right now, you can take 100% federal bonus depreciation on that. So you're writing that all off. You're expensing that all in the first year on your tax return this year.
So I want to, go ahead.
Makes sense if you're subject to some other limitations. But yeah, you can write it all off for the first year on your federal return. Now, North Carolina and some other states don't necessarily conform to that, and so you have adjustments at the state level, but the taxes at the federal level, the tax rate at the federal level is usually higher than the state. So it's a benefit to, most of the time, benefit to take that bonus depreciation.
I just want to translate that to dollars, because I don't think, like, people hear that and they're probably like, okay, yeah, I guess that's cool. But like, let's translate that to dollars for a second. So let's say, even if all that property was 5-year, which it probably isn't all 5-year, but let's call it all 5-year for easy math. We had 25 grand. That means this year I'd be able to write off like $5 grand, right? And let's just say, give or take, and let's just say for easy math that we're talking about someone who's in like a 20% ish. I know that's not a real tax bracket, but give or take a 20% federal tax bracket. So that means that effectively I'm going to pay $1,000 less in federal taxes this year, because I've got $5,000 of expenses off of that $25,000 investment in repairs that I did, and I would have paid taxes on 20% of that, but now I don't have to. Right? Fair?
Right.
That's what it would have been. But instead, with this bonus depreciation, what we've got is we can expense $25,000 of it this year, and if we're still in that 20% tax bracket, that's $5 grand back in my pocket today that I otherwise would have had to pay. If of course my income and all my other stuff qualifies to be able to offset it.
It all depends.
yeah. There's all these like ifs and thens, like, don't just call up Pete and say, I need me some of that $5,000 bonus depreciation. But that's a cool thing. And I think that's what a lot of people don't understand. And maybe that's, hey, this is a little bit of a biased tip here, but buy rental property in 2021. It sounds like before the Jobs Act runs out, right? Unless it gets extended, because you get this extra bonus depreciation. And then if you are going to be doing repairs to the property, wow, what a great time and incentive to do that. And that's essentially why that's there, right? I mean, that's why the government did this, is to incentivize folks to make investment.
Yeah,
I mean,
incentivize investment. Yeah.
Yeah.
That bonus depreciation seems to correlate with downturns in the economy. When Pete and I started our career, we saw it not to the extent it is now, but coming off the heels of the 2001 downturn, they instituted a bonus. It went away for a little while, comes back in 2008. It's kind of stuck around for a while, so came back in force with the TCJA, and I think we could see maybe that schedule of it declining get pushed out potentially. And one of the important things under the Tax Cuts and Jobs Act that came in was, before that, it used to have to be new property. You used to have to, go to Lowe's, go to Home Depot, buy that, brand new to you. Now, if you go buy a used refrigerator, used stove to put into that also counts. So no matter what you're buying, it's eligible for bonus right now. But that's not always been the case. So it's one of those things, as the law changes, that potentially we could see it roll back to, I got to buy new, because they want to stimulate the manufacturing, not just the resale market.
Right.
It's not that way. And I'll play a little bit of devil's advocate, but you made a great point there, Chris, about the savings you could get. I've had a lot of conversations recently with clients talking about the delta, and this is all, this gets down to their philosophy. The tax rate may be 20% today, and it seems like a good idea to take that bonus, but if you think in 2 years your tax rate's going to go to 30%,
right,
and you've still got a lot to depreciate, do you say, and you have to actively elect out of the bonus. The bonus is a default for you. So you have to actively elect out of it. If you say, I think my tax rate's going up not only next year, but in the years after that, maybe saving that deduction for a future year is something you could consider, particularly where, depending on your alternative investments, right, in a very low interest rate environment, time value of money right now is pretty low. So any jump in the tax rate to be able to deduct future rates could potentially be a benefit, but we don't know where that goes.
Right.
But a consideration to think about.
No, I'm super glad you brought that up, Lance, because it's true. One time we sold a rental property, and it was a year when we sold a bunch when we were moving from Seattle. In hindsight's 2020, man. But again, this is the downside of not hiring someone like Pestifini, right? So little old me, I think we sold it in like, it was like the tail end of 1 year where we had sold several other properties.
Mhm.
I think our close date was like, I don't know, the 28th of December or something, or the 23rd. And it took us over into like this alternative minimum tax calculation. And I basically did the math and said, like, we made a lot of money that year because, you know, we started buying in 2011 and the government wanted to put their hands in the pot. And I had figured out, like, had I pushed out the contract date on the closing like a week, we probably would have taken home like another 10 grand or something like that. And I was just like, whereas, you know, what we could have done is if we knew you guys at the time, we could have sent you everything and said, hey, just want to do some end of year tax planning. Does this all make sense? You probably would have said, well, wait a second.
Wait till next year to close.
Right.
Yeah. Wait till next year.
Yeah, that's a good point. You know, if you think rates are going to go up in 2021, if you have that same scenario, you may want to accelerate it. But you also make a good point that I'll kind of piggyback off of is, you know, relative to depreciation, you need to think about your exit strategy, right? So we're talking about these depreciation deductions. They're going to get you an ordinary tax rate deduction, right? And that's those rate brackets you always hear about that go up to 37% right now. And then, so probably a lot of people listening go, well, this is great. I can get an ordinary deduction all the way up to my 37% tax bracket, but I know my capital gains rate is 15 or 20%, depending on where I fall. So look at all that rate arbitrage I get. Well, the IRS, believe it or not, smart enough to figure out that there is that rate arbitrage and they're not going to give you a free lunch. They're taking a lot of that bonus depreciation today, and they have some calculations to say, well, if you sell that piece of property, you've got to recapture it, and you know how the calculation works, at those ordinary rates. So, you know, you take a bunch of bonus today at a 37% rate, you turn around and sell it in 2 years and the rates moved up to something higher, you could find yourself taking a deduction at a lower rate than the income you have to recapture. So a lot of times where clients come to us and say, hey, look, we want to rent this, but, you know, it's appreciating. This is something we may not hold on to long term. We may end up selling it, not dealer status. That's a different animal, but we may sell it soon. We do have a robust conversation around, does it make sense to take that bonus depreciation, because we saw it in a couple of years, even if it's at the same rate, your bracket may be higher, or given the politics, you know, your rates can go up too. So if it's not a super long-term investment, those bonus depreciation deductions are something you may want to think about, or at least have a conversation with the CPA about.
Yeah, that's a good point, because essentially the default is, unless there's another kind of benefit or strategy around this we'll talk about a little bit later to maybe delay that even more, but kind of the default is like basically what you're getting is a free loan from the government, but it may end up costing you money depending on what tax rates do in the future, is essentially what you're saying, right, Lance? Like, hey, you get to take a big deduction today, maybe not pay some taxes, but the piper's going to come knocking at your door 10, 15 years down the road when you go to sell this bad boy, and hopefully the tax law has changed in your favor, or you have some other strategies to help deal with that, but you are going to have to kind of pay that loan back. But man, as investors, you know, leverage, it's another advantage, and we do love free money. So
right, yeah, I mean, so yeah,
free money, you got to take it.
Yeah, if you can take your tax savings, leverage it up, and you know, find another piece of property that you like, that's a good investment, it still may make sense even on a 1 or 2 year time horizon.
Sure.
With rates going up, it's all about the trade-off between where you think tax rates are going, the return on your dollars that you can get. But you know, if your plan is to put the tax savings in a, you know, money market or something like that, then, you know, I think you got to work a little bit harder. But if you leverage it into a real estate property that, you know, 10 or 12% return on, you know, on an annual basis, it makes a different sense. So it's you got to think about the tax consequences in conjunction with the broader economic consequences. You know, one of the things we always tell people is, as good an answer you can get from a tax standpoint, you don't want to completely throw your economics. Don't let the tax tail wag the dog. You got a client every year, he goes, should I buy a new truck this year? And I said, well, you know, you're spending $1 to save 40 cents on that truck. You're still out 60 cents. The new truck, you know, he owns a business where he has to use that. If you need the new truck for business, then great, buy it. But, you know, can't tell you that to your pocketbook, even though you get the tax savings, it's a good answer because you're still out that 60 cents.
Absolutely. Now, so is there a way to delay or potentially avoid paying that depreciation recapture? So if we take that as an expense, either accelerated through what the Jobs Act allows us to do with bonus, or we depreciate it over on a normal schedule over the next several years, when we go to sell that property, is there a way to avoid paying that tax legally?
Legally.
Yeah.
Through a like-kind exchange. Is that what you're getting?
That's what I'm getting at. Yeah,
That's
I'm
what
jumping ahead.
Yeah, no, I know.
That sounds a good segue. Yeah.
Yeah, it is. So yeah, if you reinvest those proceeds from the sale of your property into another property, you can delay the payment of tax through what's called 1031 or like-kind exchange. Now, you want to make sure you're working with sophisticated people that know what they're doing in that instance, because you can't have the cash in your pocket. You can't go to closing, get the cash, and then use that cash to buy another property. You got to use what's called a qualified intermediary to hold the cash for you if you're not doing simultaneous closings. So, and there's time restrictions. Like you have, from when you sell the property, you have 45 days to identify a replacement property, and you have 6 months to close on that replacement property. So you want to be working with someone that is familiar with that and knows what they're doing. But yeah, it's a good strategy, although capital gains rates are pretty low right now. They're probably only going up. So that's something else to consider too.
So in theory, this is kind of like the game in Monopoly, right? Where you start with one little house, and then that little house appreciates over time. Plus, you've taken some deductions and things like that on it, and eventually, hopefully, you've been saving some more money. And now you've got enough equity built up in that little house that maybe if you can take the equity out of that without a tax impact, you can go buy, you could take 4 little houses. What is it? Take 4 little houses and you buy one big hotel type of thing, right? I mean, that's kind of what this helps investors do, is continue to trade up and buy more and more and more property. And now, is this true, Pete, that like basically can you do this? Like, let's say I start with one property and I do a like-kind exchange into the next. 5-10 years from now, when I sell property number 2, can I roll it back into now property number 3?
Yeah, you can keep rolling them. Now, the more you roll them and the closer you roll them together, the IRS could come and argue that you're really dealing properties and you're not an investor. But in your scenario where you're waiting 5-10 years to sell that one and go into another one, that shouldn't even be an issue.
Okay. Does that... go ahead.
It's a great tool that we've seen a lot of our clients use. And, to your point, Chris, what we see a lot of times is, they'll sell one and enter into a 1031 exchange and use those proceeds to buy 2.
Yeah.
And, you don't have to necessarily say, okay, I got a house and I'm going to have to buy 2 more houses. You can 1031. The rules have recently changed, but real estate still qualifies. Real estate's a pretty broad category.
Yeah.
You do have to be careful rolling out of a rental house into just land unless you're going to build on that land. And it doesn't mean that, you can't buy the land and build on it after the 1031 exchange. So there is some flexibility there. It's not like I got to have a rent-ready house to a rent-ready house, right? I can go into a commercial building if I wanted to or something like that. So it is a powerful tool. Talking about, future tax law changes, one of Biden's proposals was to completely finish getting rid of 1031. So, before the Jobs Act, you could exchange breeding cows for breeding cows. That was like-kind property, and there was some things beyond real estate. It's been narrowed to real estate. So it's the last bastion in the 1031, fortunately. So it's still a powerful tool. And I will say, I think, most of the listeners are in North Carolina, but if you do find properties in other states or have legacy properties in other states, just like with Pete mentioned with the bonus depreciation, some of these states, Pennsylvania is first in my mind because I've had to deal with it, don't really follow those 1031 rules. So you may be able to execute this tax-free exchange for federal purposes, but be careful of the state you're either entering or exiting. Most of them do it, but some may not adopt it. So again, getting back to having, good tax counsel is important.
So right now, did you say is North Carolina one of those states that recognizes 1031s?
It does.
Okay.
So,
Okay.
if you're selling a house in Charlotte, buying a house in Raleigh, no problem. Even South Carolina,
Yeah.
you can cross state lines with these things. You just don't want to cross the wrong state line.
Yeah.
Because like I said, Pennsylvania is definitely one of them where if you go into Pennsylvania, that's fine. They'll let you buy it all day long. But if in your example where, 2 years down the road, you want to do another 1031, you can't even do that within Pennsylvania.
Wow.
They're going to make you pick up that gain. So you just want to be careful of what you're deferring into in that case. Oregon's another example. They don't make you pick it up immediately, but you always have to file in Oregon until you sell it in a taxable transaction. Then you got to go back and pay Oregon. So you may have to keep track of an Oregon property for 20 years or more. Who knows?
Man.
So there are some state considerations to that as well beyond the federal benefits, which are substantial.
Now, I've kind of heard, and I'm going to throw this one at you, a curveball you may or may not know off the top of your head, but let's say I just keep 1031ing properties, and then whatever I have in my portfolio, I just leave to my estate when I die. Right now, the way it's written is basically all of that deferred tax forgiven, or do we still got to pay the piper?
No, right now, the way it's written is there would be a step up. As long as it goes through your state, there would be a step up in that basis. So if you've rolled and rolled and rolled, you've got low basis property, maybe because you've been depreciating, you've got maybe $50,000 basis in this property that could be worth millions, So when you die, I don't recommend that but it is good tax planning. You get a step up.
You don't recommend dying?
Yeah. Tax wise, yeah, but you can't always let the tax tail wag the dog. So yeah. Currently there is a step up in basis if it goes through your estate. So
yeah.
So essentially, what we're talking about is you start with the one little house, and it's right now. Now, don't get me wrong. This is not like a rubber stamp exercise. Oh my goodness, we're just shuffling around some paper. Executing a 1031 is challenging. I've tried to do it and couldn't identify property in time. So it's not super hard, but it's not super easy peasy either. But with some intent and some planning and forethought, anyone can do it. In the right people on your team. But essentially what we're talking about is you could start with a one little house, get a bunch of expense written off for it. If that thing appreciates over time, you buy more houses, those appreciate over time. All of a sudden you have what otherwise would be potentially millions of dollars in capital gains that essentially get deferred, twiddly fingers for those who are only listening and not watching. But upon death, you end up never paying taxes on that. So, like you said, death is not a good tax planning strategy. Well, it's a good tax planning strategy, Pete, but not something you recommend. But if that's kind of your long-term plan is hey, I want to accumulate this portfolio so I can build up, I can build up my legacy and hand that off, whether that's to charity or kids or whatever.
Right.
This is a really great way to be able to do that more quickly, potentially, if it's right for you.
no,
Yeah.
that's right.
No, that's right. It is a powerful tool, but to tie that back into depreciation too, because you're not paying tax as you go, you've still got a lot of times that lower basis that may be fully depreciated. So as you go, unless you're in the houses you're buying, you're paying substantially more for them than what you sold the old one for, and making capital improvements for them, you are losing out on potentially those depreciation deductions. So yeah, you're deferring a ton of capital gain, great, but there's no free lunch. And so some of that depreciation you may not see.
That makes sense. Okay. Yeah. Cool. Awesome. So I think we kicked the depreciation horse to death. We talked a little bit about you got depreciation and then you have your normal expenses. Just kind of some of the typical type of stuff that folks can can write off typically as expenses. What does that look like? And then are there some more unique things, for people to consider that maybe aren't typical, but are something that are possible?
I mean, any expenses relating to the property, like your insurance, the property management fees, what you pay CPA to do the return, if it's in a separate return, interest on the house, taxes, that kind of stuff. And then even mileage. I guess if you track mileage driving to the property, if it's strictly for business purposes, you can, it changes every year, but there's a cents per mile that you get as a write-off.
Yeah,
I had a client one time who tried to claim that he could come in from LA and visit with me for coffee. He let me buy him coffee and wanted to write that off as an expense for his investment property. Would you or would you not recommend that?
It's a little aggressive.
yeah.
I should also say his mother lived here, by the way.
There you go.
I think anytime you're looking at things, so, certainly anything like people saying it's directly property related, you can say, I can't use this for anything else, right? I mean, it's here, it's either tied down, or, it's the interest, it's the insurance and everything else. That's the easy stuff. And then you get into, well, how am I using this for business and personal? And I think the word primary is probably important. And then you say, okay, am I primarily using this for business? Was the purpose of his trip primarily to visit his rental property and see that? And on the way out of town, stop by and said, hey, Mom, got to go. That's more likely to be a deductible business trip than I came here to see my mom and drove by the rental property and said, oh, yeah, there it is. It hadn't burned down yet. Then that's probably a different answer. And so, to the point about the car, the mileage rate, I think, is great. If it's something that, you've got one or two properties, you need to go to them once a month to either collect rent or just to check on them or whatever. You're primarily using it for personal purposes. That mileage rate allows you to track your business miles. You need to keep a log. There's apps out there that can do that. Or, what I do is Google Maps. And I said, okay, tick mark trips, right? I know exactly how many miles it is from home to the property or whatever. So there's a variety of ways you can do it. But, I'm sure you get a lot of questions, or at least we do. People say, well, does it make sense to buy my car in the business, right? And I go back to, well, you're primarily using it for business, and there's a lot of strict rules around that. Maybe. But if you're primarily using it for personal, you lose a lot of those benefits of having that car in the business. You can't take the bonus. You don't really get the accelerated depreciation. So, the more you're doing with something, the better the tax benefits are going to be, but it has to primarily be in that business category. And, that coffee, right, that you were saying, is that a business expense because it was a meal or whatever?
Is my business expense. He made me buy it.
Right,
it's definitely an expense for you.
Even then, right, the conversation had to primarily be about, it had to be a substantial conversation around business, right? You can't just, well, how's the weather in LA? Good, all right, see you later.
Yeah.
So, you get back to facts and circumstances on that, and if the IRS ever comes in and looks at that, what's always important to have is contemporaneous documentation around that, right?
Sure.
Whether it's tracking your mileage, or, as I think we'll probably get into a little bit later, talking about how much time you spend in the property to move rental real estate from passive into active. Just saying, okay, Saturday went down to the property and worked 3 hours painting, replacing light bulbs, cutting the grass, whatever it was. That's what they're looking for, contemporaneous documentation. And so those things are important. Whether it's a true rental property or even a vacation home, that becomes important as well.
Yeah, I imagine that gets kind of messy. Even you bring that up. I mean, vacation homes aren't really something we do, like Airbnbs and that kind of thing. But I'm guessing with like a mixed use type situation, that gets kind of complicated. I'm sure, right? Because I would imagine you don't get the full benefit of it being an investment property.
Yeah, so
I'm sure you guys love those.
I use vacation home as a technical term under the tax code, believe it or not. So if it's a vacation home, but you use it personally, that's still personal. But if you both rent and use it personally, yeah, you get into a lot of complicated rules around that. And one of the things that's important in that is when you're counting those days, what are considered work days don't count for your personal use. So, again, that gets back to the contemporaneous documentation of the primary purpose of this trip was to work on the house. Did we go to the beach? Sure. But, most of the day I was painting, cutting the grass, fixing the roof, whatever it was. So you need to have that around it to support those days.
Wow. So like go to Lowe's every morning, Monday through Friday. Is that what you're saying? And save your
yeah, and stay through lunch, right? I mean, you get the preponderance of your day doing something.
Wow. Okay, cool.
Yeah.
Hey, I want to go back to something real quick that that I kind of mentioned earlier on when we were talking about, and I'm going to kick the depreciation horse again, unfortunately. But this whole idea about like cost segregation, we don't have to get like super into it. Otherwise people are going to be falling asleep while they're driving and crashing and things like that. But can you help me out with, because you guys, I found like a lot of accountants I talk to, usually you got to pay someone a chunk of change to do something like this. And it usually only makes sense to do it on like commercial property. But you guys will actually provide a service, right, where you'll help break some things out in a little bit more detail that maybe, again, depending on what your, like Lance was talking about, like your strategy on how much deduction you want to have now versus in the future may or may not make sense for you.
Right.
But can you share a little bit about like what is a cost segregation for laymen who know nothing about accounting and maybe why it's beneficial?
I mean, you are correct in that you're probably getting more bang for your buck on a big commercial building rather than a single family home. Because in your example where you're spending $25,000 on what is it? I mean, you and I can sit down and go through it and kind of pick out, oh yeah, we can deduct that. That's a repair. That's something that's 5-year property, and we can write off through bonus depreciation. We can do that on the surface level. Now, what a cost segregation study is when you have an engineer, basically, we don't do them, but we work with someone that does them. An engineer comes in, looks at the blueprints of the property, can identify that wire goes to that fixture, and since that fixture is 5-year property, that cost of that wire is 5-year property, and so they can break out more than we can just looking on the surface. They can break out more stuff into shorter lived assets and therefore get more depreciation up front. That's what it is. And I don't think I've seen it on a residential.
Yeah, it's kind of like it's 1031 where, it is an engineering study. You need somebody to do that for an official cost segregation study.
Sure.
It's going to cost you some money, so you got to look at how much benefit you're going to get. And we generally see it on specialized commercial buildings, medical office, warehousing that's uses a special purpose and things like that, right? I mean, what's hot in the news right now is cold storage. So if you were going to go out and buy a cold storage facility and you need all this extra power and everything else, what they would say is, well, because this outlet fuels this super cold refrigerator and you had to spend X amount of dollars on the HVAC, which would otherwise be real estate, and this wiring is more heavy duty than the outlets. They can trace that to say, well, that all benefits this piece of equipment that's 5 years. On a residential house, you're probably not going to get that scale and that leverage, those kind of costs that I don't think. But, as you're buying new stuff, obviously easy to identify the equipment that you're replacing in the refrigerators and the stoves and stuff like that. But the example I think that's probably pertinent to what happened with you, Chris, is I buy a new house, I need to fix it up, I hire a contractor, he goes out and fixes it up, and here's my bill of stuff, right? And, I think it's easy to say, well, that's all, building, and that's 27 and a half year. Well, wait a second, there's this line item down here at the bottom of the bill that says he hired a landscaper to, put new sod down, right? So that's shouldn't go in my building. I put a new fence up, as Pete alluded to, that's a 15-year property. Stuff inside it, you're probably not going to be able to do that wire tracing in a rental house, but you'll want to look at what's inside versus outside on that bill and maybe get some advantages to be able to do that. And that just, take some time to go through that line by line.
Awesome. Thank you. So you guys were talking a little bit about like active versus non-active. What does that mean? How does that apply? Why does it matter?
So non-active or passive, what that means is basically, first off, rental real estate is inherently passive. In the tax code, it specifically states that real estate is passive. Now, if you have passive income or losses, so passive losses cannot offset active income. So if you have a loss from your rental property because you took bonus depreciation, but you have a job and W-2 wages, you can't take those net passive losses and offset your income. What happens is they get suspended and they go forward until you have passive income from your rental or you sell the property. Passive income is also not the greatest unless you have passive losses. Passive income is not the greatest because right now that's subject to the net investment income tax, which is an extra 3.8% tax. So if you can, you want to be non-passive or active. And like I said, real estate is inherently passive, but if you're a real estate professional, you can get there where you're non-passive. And that's where you're keeping your contemporaneous logs. You have to work 750 hours in the real estate business during the year and spend more than 50% of your time during the year in real estate. So for those people that their day job is something else and they're just investing, they're more than likely going to have passive income from their, or passive losses from their property.
Yeah, again, they're complex rules.
Yeah.
And it's circumstances based and it's year to year based, right? So, you can't say, well, I was active this year and therefore I'm good from now until the end of time, right? Every year kind of stands on its own to make that determination. And the more you personally are physically doing on the property, associated with it, the more likely you are to rise to that standard of having what's called non-passive income or loss. And really the downside is on the loss, right? If I want to take these losses that my depreciation's given me off my rental property against my W-2 income or my dividends and my interest, I need it to be non-passive. And so you've got to do a lot on the property with that. And there's the hour requirements that he was talking about. So, if you're just getting mailbox income off your rental properties, somebody out there is doing something and you just walks a mailbox once a month, you may not be able to access those losses. But, if you're Mr. Handyman, you're out there, you're the one fixing the roof, you're the one mowing the grass, you're collecting the rent, then you can probably get there in all likelihood. So it's gradations. And again, that gets back to tracking your time, because if you say you're not passive in this activity, what the IRS is going to come in there and say is, prove it. And you go, well, spend a lot of time doing it. Again, prove it. You have to have that contemporaneous written documentation. So, make a note, whatever it is, however you like to do that. December 17th, drove out to XYZ property and, surveyed it for an hour. You don't have to physically be doing the work, but inspected it to check for, no leaks or whatever, or, actually found a leak and fixed it, whatever it is. So those rules are nuanced, and you got to kind of maintain that standard. But if you can get there, it's beneficial. This came in back in '86 when the depreciation laws were a lot more aggressive even than they are now to some respects, and you get doctors buying these tax shelters that would generate all this depreciation. They could offset their ordinary income back then, and the IRS said, well, wait a second, we got to put some bumpers around this type of income where these guys aren't doing anything, but they're wiping out their wages. And passive rules came in and have been around for going on 35, 40 years now. And real estate was really the target because of the perceived abuses, air quotes, that were there. And so that's why, as Pete said, it's a per se passive activity. So you need to prove that you're doing enough to overcome those hurdles.
Yeah. So I appreciate that explanation. So it's basically that same doctor example now, as of today, anyway. If they've got all this depreciation they claimed on their investment property and it's passive for them, then really the only income that might offset is other passive income, like you said. So if they have other investments like stocks or that are producing dividends or interest, things like that are coming in, then that maybe offsets that income, and that's what and maybe reduces tax liability.
It's not. So it'd have to be other passive income. So like there's the interest and dividends and capital gains from stocks and stuff. That's portfolio income. So
different.
That won't offset the passive losses.
Yeah.
What are other examples of passive income? Now I'm super curious.
It would just be other. Maybe they're invested in another partnership that they get income from. Maybe they're in a rental partnership. That's what we see a lot. I mean, that's what we deal with real estate a lot. So that's what we see. But yeah, maybe they're in another real estate deal that kicks off passive income too.
Okay, so if I only have one rental property and I have a regular old W-2 job and I've got my portfolio of stocks and bonds and retirement accounts and everything, then maybe this isn't as big of a benefit as I'd want it to be. Is that fair?
It depends.
I love it. This is why we hire you guys.
Right. Well, first of all, it's not like it goes away. It's just that you're limited to how much, you can't below zero in a given year. But, I have $10,000 of loss this year, $5,000 of income next year. Well, that $10,000 of loss carried forward. Now I don't have any income and I've still got $5,000 of loss carrying forward too. So, it's not like this goes away. And even if I don't have net income next year, but I sell the property, that $10,000 frees up. So, I mean, it's accessible. It gets back to the time value of money when you can use it. So it was designed not to get rid of the benefits, but just to smooth them out.
Yeah. So is it pretty typical that you guys see that, that most investments, real estate investments, I guess this is kind of what I've seen is that a lot of real estate investments, unless you've had them for a really long time, a lot of times folks have more than enough expenses to get their net income on that investment down to zero or less. Is that a fair generic statement, or is that it depends again?
Well, it depends, but
it depends, obviously.
It does depend.
Yeah, because you're depreciating the property. You've got, if you bought it with debt, you've got mortgage interest on it that you can deduct the interest. You got the property taxes that you can deduct. So yeah, unless you can get there a lot of times to almost wipe out all the income. Okay.
Yeah.
It all depends.
Yeah.
Now back to your doctor example, something to think about would be, well, if the wife's not working, maybe she can be a real estate professional. Spends half her time in real estate and 750 hours. She could be a real estate professional and free up, and then that income becomes non-passive again. Although, again, she'd have to really be doing it and having those records. But if one spouse is a real estate professional, it's not passive.
Yeah, awesome, very cool. What about so right now, if you're a business owner and you take distributions or something, there's like the 20%. I'm totally going to mess it up if you guys let me talk too much longer. So there's like a 20%, some sort of reduction or offset, right, in your income you can take. And I thought I heard at one point that maybe right now, does that apply to real estate in certain circumstances, or no? Am I totally messing this up?
No, keep going. Let's see how big the hole is.
Oh man, this is going to get worse the longer I go on, Lance. Don't let me keep talking. Save me, help me, please. Help me.
No, we're kidding. Yeah, there is. So,
that's your answer? Seriously?
Yeah, there's a deduction. The qualified business income deduction is what you're talking about.
Okay.
Basically, with that Tax Cuts and Jobs Act, when they dropped the corporate rate, they wanted to give a break to small businesses too. So they added this qualified business income deduction, which is 20% of your qualified business income. Generally, yes, real estate should qualify for that. Now, there's limits if you're a high income taxpayer. There becomes limits based on your depreciable basis of the property. There's also the question of whether you're just collecting that check in the mail and not really doing anything on the property. No, your tenant's paying everything, as far as like CAM insurance. Then there's a question of whether you really have a trade or business for qualified business income. But generally, yeah, you can get there with real estate and have that. If you have net income and not those passive losses, if you have net income, you can get there with getting a 20% deduction. And it's not based on the distributions, it's based on the income of the property.
Yeah, so it's if you own it directly or via partnership, the answer should be the same. And we've had some interesting conversations recently to keep beating the depreciation horse, and I have to disagree with you, Chris. You can't beat that thing to death. It's a blessing.
You can beat it to sleep. I can guarantee you that.
Yeah, that's true. It maybe on the ground, but it's not out yet. So we've had some interesting conversations with clients relative to the QBI versus depreciation versus some other tax deductions and things like that you can take because they think rates are going to go up in the future. The 20%, as it's construed right now, is essentially a free deduction. You don't have to do anything for it. You don't have to. You have to own property and meet certain thresholds, but the IRS is just saying, hey, we lowered the corporate rate. We want to give you something if you meet the right criteria to kind of lower your individual rate, which is 37% at the worst case and 21% for the corporate rate. So we wanted to kind of close that gap. So we're viewing it as kind of a free deduction. Well, does that mean that you want to push off these discretionary deductions like bonus depreciation and things like that, and they have longer term benefits to sort of take what you can get for free for now? But then you've got to sort of make sure you meet it too before you go down that road. You got an older rental property that you may have only paid $50,000 for that throws off $2,000 a month in net income. You may be over the threshold, so I can only take a deduction to the extent of 2.5% of that $50,000 in my case. So if it's throwing off a ton of income, but I have low basis in it, taking depreciation where I can get it may make sense because I'm already maxing it out, and so I'm above the line. New property with high basis and otherwise break even or a little bit of income without the depreciation, and they say, well, I'll push that off because I've got capacity to take more of that free deduction. So it's out there, it's available, but it's going to be based on your facts and circumstances with your property, how much you do with it. They were kind enough in sort of the safe harbor that Pete was talking about and how much time you spend in it to tie the hours in that to absolutely nothing related to the passive. So, it's another threshold, another number you have to remember. 200, I think it was in that case. Yeah. 200 hours. So it's different than any of the passive limits that we talked about. So, again, it gets back to your particular facts and circumstances, how much you're doing, and how much you've got in that property. So, again, going all the way back to the beginning, complexity, not simplicity, if you own these sorts of things, and having good advisors is helpful on that front.
Yeah, no kidding. This stuff excites me, and now you got me confused. So I just say hey, here are the numbers, here are the receipts. Here's my shoebox, right? Don't give me.
We don't want a shoebox.
Yeah.
Go to the guy down the street if you got the shoebox.
Yeah, we got a guy for you. If you come in with a shoebox, we got another guy for you.
We've got a special broom closet for you.
That's right.
The shoebox.
Right. But no,
I mean, it is a great point. There's a reason you guys got to go to school so much. And no offense to you, but I tell my wife this all the time. I think it's ridiculous in this country that you got to have a 4-year degree and a ton of training and all these certifications just to be able to know how to pay your taxes. I mean, it's good for you guys. It's great.
It's good for us, but I totally agree with you too.
It's just,
Well,
it's getting to the point too, because I agree with you too. I mean, it's kind of crazy. It's getting to the point, as we kicked off, right? I mean, you have a civic duty to pay your taxes to the extent you earn income, but you have to then pay somebody with such specialized knowledge to even know that, is this the right amount?
Yeah.
Well, here's what I think I owe, and then the IRS may or may not later come back and tell you, you think that may or may not be right, and now let's argue about it. It is a little squishy, and that's why I think people are nervous around taxes, which
sure,
I don't think you shouldn't be per se. I mean, if you got a good advisor, you're not going to be doing anything illegal or anything like that. So, but it's burdensome, and it's if we do it every day in and day out, and spend 40 hours a year plus in CP and have graduate degrees, and it's complicated to us, that I think to what's known as the tax gap, right? I mean, it's hard to comply with a law that, it takes law degrees and master's degrees to understand. And so, even people that want to comply, it's tough to comply even if you want to accurately. So,
that's true. Yeah. Like as I've learned as I talk to more CPAs, right? It's like, and we've even had it on this conversation. It's like, well, what's the right way to do that? And the answer isn't, is it right? Yes or no? It's like, that's either conservative or that's aggressive. Well, what's right? Well, I don't know. I can't tell you. It's either conservative or aggressive.
Yeah. If I don't end a sentence generally with "it depends," then I should have probably. That really is the ultimate answer. We could have made this a 15-minute podcast, all your questions. It depends. Next. It depends. Next. But it's true. It's true. It's facts and circumstances play a big part of it, and interpretation of the law, particularly as we get new law. A lot of this stuff, the 199A, the 20% deduction. Even though that statute was passed in late 2017, going on 3 years. Regulations and more detailed guidance just came out, this year?
Yep.
That's still unfolding, the guidance.
Wow.
And will continue to for not only that, but other parts of the law. So, and even then you have that guidance. A lot of times what really solidifies some of the interpretations is case law. So you'll have to have some of these things work themselves through the courts, which will take years too before people really get comfortable with it. So, the passive rules that we talked about going back to 86, I wasn't around then, but what everybody says is, it took a while for everybody to get comfortable and understand it. It's still complicated, but at least there's sort of settled law and interpretations around it. But that's a 10-year process. The Tax Cuts and Jobs Act set the sunset in 2026. So the law itself isn't even 10 years long. So,
wow.
adding to the complexity of the things that not only we have to deal with, but taxpayers responsible for that too, or they have to deal with it if they do on their own.
What about we get this a lot where owners, it's your primary residence and you're thinking about converting it into a rental property, and maybe you've owned it for a while or maybe you haven't, and sometimes I think there are some tax consequences about that that'd be kind of interesting to talk about, like how do you calculate basis and how does that affect depreciation and everything at a high level. But then the other thing that always kind of fascinated me is, I'm not sure that people always understand this, is when they've had a rental property and now they let like a son or daughter or cousin or aunt or whatever live there, or they themselves decide they want to move back in, potentially are there any consequences there? So I'd love to hear your guys' thoughts on that. I know, again, like it's all situation specific,
right?
But just generically speaking, what are some things to think about as if I'm kind of in that situation where I'm either thinking of moving out of my house and making it a rental, or I already have a rental property, I'm thinking about moving back in or moving a family member back in. What are some things I need to be thinking about?
So to start off with, if you sell your primary house, your principal residence, there's for a couple, a $500,000 gain exclusion. So a lot of times when people sell their house, they don't pay capital gains tax on on that sale, because a lot of times they don't make $500,000 on the sale. Now, there's time restraints to that. You have to, so if you're converting from a primary residence to a rental, you have to get that gain exclusion, you have to have lived in that house for 2 years out of the past 5. So if you know you're going to sell it somewhat soon, but you're not ready to sell it yet, you can move out and still have access to that gain exclusion. But once you get past that 5-year period, that goes away. But and then as far as basis for depreciation, once you convert it to a rental, you can depreciate it, and it's either set at the lower of the value when you convert it to the rental, or what you bought the house for. So if the house has appreciated in value since you bought it, you're still going to only depreciate that original cost that you had in it. But if it declined in value, now you're setting your basis for depreciation at the new value. Basically, they're not letting you convert it to a rental and get depreciation on something that you didn't really pay for, if that makes sense.
Yeah,
No free.
I think it does.
No free lunch.
Those rules are have their own level of complexity around it. And one of the things I want to point out, Chris, that in your scenario was saying, I've got a rental property and I want to move a relative in there. If the relative that moves in there uses that rental property as their primary residence, then you can treat it just like it was before as a rental property. Right. So, but it has to be their primary residence. If you had a beach house and you say, well, I only let my kids use it, but they pay me fair market value rents for it, because it's not their primary residence, that's not a rental house, and you don't get the same answers. So as long as they use it for their primary residence, you actually get a pretty good answer. And, I'd be careful when you transition either way. Like you said, rules are complex. 1031s are complex around that, right? I mean, you can probably hear people going, well, I'll just 1031 into a new house rent for a couple of years and then make it my primary residence. That may work, but the 1031 rules put restrictions on how you hold your replacement property. So you got to be careful around that. And then, if you have ever rented the property and make it your primary residence, Pete and I were talking before this, that's a complex calculation, and you have to, look back at the original basis. You have to know the depreciation. So even if you rented it for 5 years, lived in it for 20, you really need records going back that full 25 years. And then you do a prorated.
Yeah, you don't have if you rented it and then moved into it as your primary and thought, well, you want to get that $500,000 exclusion. So I'll just move into it for 2 years and then sell it. That rental period still taints the whole gain. So
right.
You still might get some exclusion based on the time you use it as your primary residence, but you're going to gain on that rental period time.
So when you go to sell, essentially you're going to have, instead of just looking like, hey, it's like a personal property and you got this $500,000 exclusion, right, or just looking at it as, hey, it's a rental property and what's your basis and do you have any depreciation recapture and all that other stuff. Now you're kind of doing a hybrid of the two. Is that essentially what you're saying?
Because they don't want you to just move into it to get the exclusion and then move to get the exclusion. They put some rules in that kind of.
But if I do move back into it, like let's say it's been a rental for 10 years and I've taken a boatload of depreciation on it or something, I move back into it. It's not like Uncle Sam's going to send me a tax bill that year saying, hey, now that you've converted it to a primary, you've got to, not until you go to sell.
Not until you sell it, right.
Yeah. Okay.
Yeah, and, depending on your facts and circumstances, if you go from primary to a rental property, you should be able to, if you want to sell that, you should be able to 1031 that. If you go from rental to primary residence, you're not going to be able to 1031 out of that. So your exit strategy, if you've gone from rental to primary, is a sale, and you're going to have to pay that pro rata.
So that's a good note. Yeah. It's kind of interesting. Yeah, it's kind of tricky because, like, a lot of folks, they like even what I think of is my house. My wife and I have talked a lot about, like, at some point in the future, when we move out of this house, we kind of bought it, moving over to the area, like, hey, let's just buy something that is well within our means, and like eventually we think could be potentially a rental,
Right.
if we wanted it to be. And you kind of look at the mortgage you have on it now, having a primary, especially today's rates, right? Like a primary mortgage, 30-year fix, like super competitive rate. And you hate to get rid of that mortgage, although they might be the same in the future, but you hate to get rid of that mortgage. And you look at the potential rent you could get, you're like, wow, that's really, really tempting. But what you're saying is like, hey, if there's a bunch of equity that's built up in this thing, before we go to convert it to a rental property, may or may not be able to include that as part of basis, or may not be able to participate in that capital gains exclusion if I hold it for more than 3 years as a rental.
Right. Yeah.
Right.
Yeah. That's exactly right.
Yeah.
If your time, a lot of times in tax transactions, is your friend, so whether you're going from rental to primary to rental, the longer you're going to do either one of them, right? Your proration gets better as you move from rental to primary, and you may not have the basis, but you're not going to get rid of the tax taint that's associated with it. But it may make it a little bit better because you get the time value of money. If you're looking to go particularly from primary to rental and sell it in a couple of years, you may just say, well, let's sell it today because I can get my exclusion, right? I don't have to think about that taint. So again, thinking about your exit strategy a lot of times as you contemplate these sorts of things is important too.
Yeah. Man, awesome. What else did we miss? Did we cover the entire tax code in an hour?
I think we did.
It depends.
We got through like half a page of the tax. Yeah, I would say the one thing that I'll bring up, and this could be like 50 other podcasts. Some of your listeners may have heard about opportunity zones, and we talked about 10 zones as a tax deferral strategy. That's one too, and all I'll say about those is, those can be a powerful tool, but as many of the pitfalls and things we talked about in all this today, that has as many, if not more, going into the opportunity zone stuff. So if that is something you're considering, like a 1031, that's not a step you want to take kind of on your own. Talk to a tax professional about that. We've seen, I bring it up because surprisingly enough in 2020, I feel like I've seen even more interest around those type of investments. And a lot of people maybe as investors may look at it and say, well, for both economic reasons, I can buy potentially underpriced housing in distressed areas. I can, watch the value hopefully appreciate, but I can also get some rental income and maybe at the same time provide, Charlotte's got a dearth of affordable housing. They may be able to meet some mission type goals that they have of providing a little bit more affordable housing. So it may be a nice intersection for a lot of things for them. Those rules are very complex. Make sure you consult with a professional if you're looking to go down that road. Because even internally, we have a lot of conversations about it. The more I learn about it, the less I feel like I know. So it's a strategy out there. I'm sure a lot of people have heard about it, but it's one you got to be careful with.
Awesome. Speaking of tax professionals and reaching out to them, so if someone wanted to talk to you guys more, what's the best way for folks to get in touch with you guys?
Well, we've got a website. I think all of our information's on there. We're located the website's pestafinnie.com, which is PESTAFINNIE.com. And all the phone numbers and all the emails and everything are on there. And we're located in the South Park area in Charlotte right now. We got one office in the Charlotte area. Most of our clients are Charlotte-based or North Carolina-based. And again, we specialize in real estate, but we dabble in other things as well. So,
Yeah. it's a lot of letters to spell out all our email addresses for everybody. So the link, at least for mine, the link on the website is probably the best way to find our phone numbers. 704-364-1829 is the phone number. But the website's going to have all our contact information. And it has my headshot, at least. I know you guys are putting that up. And adding Pete's headshot.
It's going to be great. It's awesome.
It's going to be great. And that website is, for our clients, that does have a portal on it. So one of the technology features we have is a secure client portal that we also utilize through that website. So if we do have folks that would become clients, same website they would go to upload all their documents. So we don't have that shoebox problem that you talked about. Hopefully, even in the upload, they're organized, but at least they're digital at that point. And we can share their returns back with them, and they can share their documents with us and make life hopefully a little bit easier for everybody in the compliance process.
Awesome. Well, Pete, Lance, hey, we really appreciate you guys being on. Thanks so much for being so open and willing to share knowledge. As folks hopefully can tell, if you're listening in, very friendly group of folks. Everyone I've run across it at Pest Affinity, exact same way. Super helpful, super knowledgeable, and worth their weight in gold. So, make sure to reach out to them if you're thinking about investing in real estate or currently are. For sure, it's worth the chat just to see how they may be able to help. And really, I think if anything, like even if feel like you just got a lobotomy right now, I think the thing to realize about this is don't forget that there's just a bunch of potential extra money sitting out there waiting for you if you have someone on your side who knows how to find it. That's all you need to remember from this episode. Maybe we should have started with that, but then no one would have listened after. I don't know. But if you're super nerdy, or like doing things yourself, or like understanding why, or your CPA is just not cutting mustard, then hopefully you've got a lot of ammo here for him to go back and ask him some questions about what about this, what about that, and then reach out to Pest Affinity if you want it done well. So we appreciate you guys. Again, we are the Investment Property Geeks of Charlotte. Reach out to us at podcast@investmentpropertygeeks.com. Check us out on Facebook. Please hit the like or subscribe button or whatever your podcast player has. Leave us a review. We're very lonely. Jesse and I seek approval from you. That's how we get value in life. So please do hit that little review button. Send us a note. And we'd love to chat with you, hear about future ideas or what you thought about this episode, and that kind of thing. So with that,
thank you very much for listening. We appreciate the support. Looking forward to bringing more property management and real estate ideas your way. So thanks again.
This is Chris and Jesse wishing you, or that too, wishing you a brighter life through real estate.
I like signing off better.